Over the past year, the U.S. dollar index, which measures the value of the dollar against a basket of world currencies, has increased by 18%. For travelers, a strong dollar is excellent news. As a result, you can use your money overseas more sensibly. However, a rising dollar is undoubtedly bad news for investors. Foreign revenues will be transformed into fewer dollars as the dollar strengthens. A chief investment strategist at CFRA Research asserts that any foreign investments you possess are going to cost you in a rising dollar environment, and that those earnings are going to come in lower. Here are several reasons why a strong dollar can hurt your portfolio, as well as what you might be able to do to prevent it. Because money poured in the form of weaker foreign currencies is converted into fewer dollars, a stronger dollar limits the amount of revenue that corporations may generate abroad. Your portfolio's impact is closely correlated with your level of international exposure, which can be higher than you realize. According to analysts at the investment firm Evercore, around 30% of the S&P 500's revenues, which serves as a proxy for the whole U.S. stock market, are generated abroad. The performance drag is much more noticeable if you own a variety of international stocks, which is a frequently advised method of diversifying your portfolio. According to one of the investing analysts from Vetify, U.S. investors who own international shares get punished by the strong dollar because they're not enjoying the benefits of a local market. The performance of international strategy this year has been substantially hampered by the dollar. For instance, a benchmark for stocks from industrialized foreign nations, the MSCI EAFE index, has lost more than 20% so far in 2022. The index lost around 7.5% after currency fluctuations were removed from the equation. Advisors advise against making significant adjustments to your portfolio or deviating from your long-term investing strategies in response to any short-term market development. However, if you want to adjust your portfolio today to counteract the consequences of the increasing dollar, experts believe you can do so. You can reduce your exposure to the multinational firms for whom the dollar is the biggest drag on your portfolio by changing your allocation towards small or mid-size company equities. According to Rosenbluth, you might also want to think about increasing your investments in economic sectors that are less likely to generate gains from outside. While staples and healthcare firms are more worldwide, sectors like utilities and real estate tend to have the majority, if not all, of their revenues come from the U.S. Regarding your foreign investments, you can purchase funds that track currency-hedged variations of global stock indices. To eliminate the impact of currency changes from the profits of the underlying stocks, the managers of these funds trade derivatives. According to Rosenbluth, it enables you to concentrate entirely on the performance of the individual companies in the fund. However, over extended periods, the return you receive from a hedged versus an unhedged product tends to be fairly similar, according to a 2020 analysis from Morningstar. These funds will typically outperform their unhedged counterparts during periods of dollar strength and underperform them during periods of dollar weakness. In addition to these differences, holding hedged or unhedged funds ultimately comes down to personal preference, according to Rosenbluth. Nevertheless, he cautions against doing so in an effort to profit from currency swings in the near term. You're just as unqualified as I am in estimating whether the dollar will continue to strengthen over the long term.